Hello, my name is Fiona Berman. My ID is ENE3372. This is the presentation for Corporate Accounting Individual Assignment. Now, today's attempt is to obtain a properly understanding on income tax issues in the area of corporate accounting. We are going to look at elaborating several concepts in the accounting profit, such as taxable profit and any other concepts that's relating to in the corporate accounting field. And in order to elaborate it and understand it further, I have taken the annual report of Woolworths Limited, and looking at the figures and looking at the concepts, I'm going to analyze and come into some conclusions and summary and discuss with you what I have particularly learned from the concepts and learning on the Woolworths Private Limited. Now, firstly, we are going to look at the accounting concepts. So first, I'm going to elaborate on an explanation of certain accounting principles or concepts that I'm going to go through with you. First is the accounting profit. This accounting profit can be explained as the earning profit earned by a company as per the relevant accounting standards. Basically, it means the revenue minus expenses. Accounting profit is a company's total earnings. So these are some of the definitions I have gathered from the ASB or CPA. Secondly, I'm going to look at the taxable profit. What is taxable profit? This is a profit based on the relevant tax laws in a particular country. So it is used to calculate income tax. Taxable income is calculated as the difference between an organization's accessible income and deductions. So taxable income can be accessible income minus the allowable deductions. Thirdly, we are going to look at the temporary difference. So the difference that is a temporary between amounts of assets and liability find in the balance sheet when compared with its tax base. That's called the temporary difference. So we find generally this in depreciation. This has been defined in ASB as the difference between carrying amount of assets or liability in the balance sheets and its tax base. So a temporary difference is clearly can be either a taxable temporary difference or a deductible temporary difference. Thirdly, we are going to look at the taxable temporary difference. So this is the part of the temporary difference which could amount of payment of tax in the future. So according to the ASB 112.5, taxable temporary difference is defined as the temporary difference which will result in the taxable amounts of achieving taxable profit or the tax loss of future when we are carrying amount of tax or liability when it's settled. Then we are going to look at the deductible temporary difference. Temporary difference that would result in amounts that are deductible in calculating taxable profit or loss of a future when their carrying amount of assets liability is recovered or settled. So this is known as the part of the temporary difference which would be deductions in the future to the taxable income receiving in the future periods. Now, we are going to look at deferred tax assets and deferred tax liability as the last concepts. So deferred tax assets, what is this? So these are the tax effects which will reduce the actual tax paid in the future. When really looking into the deferred tax assets, this could also be defined as the amount of income tax that are recoverable in the future in relation to the deductible temporal differences that are carried out on the unused tax losses or the carried forward of unused tax credits. So in simple terms, there are a few ways that you can get deferred tax assets. How they are. So first one is the taxes paid or carried forward but not yet recognized in the income statement is one. The other one is deferred tax asset in the carryovers or losses. Thirdly, we can say deferred tax assets arise when there is difference between accounting rules and tax rules. So now we're going to look at lastly on the deferred tax liability. Deferred tax liability is a tax that is calculated or is due to a current period but has not yet been paid. A deferred tax liability records the state of the company will in the future pay more income tax because of the transaction that has taken place during the current period. So these can be listed, this can be, you can say when you do a sale done on an installment, we can, we will come into the deferred tax liabilities. Okay. We are going to look at the recognition criteria of deferred tax and deferred tax liability as we have discussed before. In simple terms, both deferred tax assets and liabilities needs to be recognized gross in the balance sheet unless the unit or the organization has the legal authority to set off the two, or they connect to the same tax authority. So now, and my next part is that I have selected as the company which is listed on ASX. The company that I've selected is Woolworth Group Limited, and then I have looked into their annual reports. So when I looked into the annual reports, I noticed that there's a tax expense in its the latest financial statements, the figures. It's not the same tax amount that the firms in their firm's accounting income. Okay, so in this case, when considering the tax rate of 30% for the company's accounting income, we get a different figure, and that's not the tax expense figure. So we achieve in the annual report. So however, we can see the figure consists of deferred tax and some values reduced by the previous tax adjustments. So we won't see the exact same figures when it comes to the company tax, like usual when you apply the company tax rule in an income and the actual tax expense. So they're different. Also, you see that the deferred tax liabilities that are reported in the balance sheet, articulating the possible reasons why they have not been recorded. I saw in the annual report of Woolworth Group Limited that the deferred tax assets and liabilities are offset when they relate to income taxes levied by the same taxation authority, and the group intends to settle its current assets and liabilities obtained on a net basis. And another thing that we have found out is that in this case, we saw that there is a current tax asset or income tax payable recorded. Yes, they have recorded, but it is not the income tax payable as the same as the income tax expense. So current tax liability in the company recorded by the annual statement is not the same figure as in the income expense. This is the temporary difference. So some expenses recorded by the accounting concepts or records will be different to that of the tax code. You also see that the tax expense shown in the income tax statement is not the tax paid in the cash flow statement. So one good reason is we see a significant difference in these figures. The difference is due to the reason that the cash flows derived from the operating activities is calculated adding depreciation for the earnings before the income and taxes. So when you do the minuses of the taxes, however, tax amount being in the cash flow statement accumulates the total tax paid in cash during this particular period. So this can also be including any other advances tax paid or any taxes in the income generated. So all in all, while I was looking at the figures and looking into the accounting concepts, the conclusion that I can come up with is that in corporate accounting, every concept is important, but moreover, I have observed that there are many variations how the provision of taxes are done at the different statements of accounting to the limit where the inception of where the significant difference are treating in assets and liabilities. and in income statement and the actual cash flows. Lastly, it's clear that the business aspects in taxation and how the companies claim the deduction subsequently. So these are the important things that I have seen. Anyway, thank you very much for your time. Have a good afternoon. Bye.